Okay, good morning. Can everyone who's on the call hear me okay? Excellent. So my name is Paula White, and I am your instructor for Accounting 444. And it looks like we're going to be covering partnerships in week 1, the entire subject of partnerships, fund accounting for week 2, state and local government unit accounting for week 3, and week 4 will be non-government, non-business organizations in week 4. So basically it's going to be partnerships and what other curriculum will call a non-government and fund accounting, nonprofit and fund accounting. Because fund accounting is used for nonprofits, and obviously governmental units will be covered in week 3, and week 4 will be the non-government, non-business organizations. So it looks also like it's a course that you have papers that you write. So this week you're going to have 2 papers on partnerships. Where you're going to find information about a limited liability company and make its comparison between that and a partnership. And we'll be talking a little bit about that today also. And then you have another assignment this week. Okay. And the second assignment this week is also on partnerships. And you're actually having to complete 3 problems within your text assignment. And I think that's how the course is set up for the remaining 3 weeks. So with that being said, let me just ask the group. We have 3 people on right now. And I'll just ask the group, do you have any experience with partnerships in any way, shape, or form? Okay, so I got 2 no's. I'm assuming the third might be a no also. Used to own a company that was incorporated. Oh, good, Sue. Was it a C Corp or an S Corp, or do you remember? A lot of the same accounting is the same as a corporation. It differs in the equity section, where a corporation has either preferred stock or common stock, or it just has only common stock. And then you have retained earnings, which is the beginning retained earnings plus the current year net income or net loss minus any dividends. And that is how corporations are handled inside of the equity section. Does that ring a bell on that? Sounds keep cut. Oh, it is. Try something differently. How's this? Is this better? A, B, C, D, E, F, G, H, I, J, K, L, M, N, O, P. Good. Thank you for that feedback. I had no idea. I will discard these earphones then and the speaker. So I'll just talk to you straight in my computer, and you tell me when there's some sounding issues, and I'll try to fix it. Is that a deal? Good. Thank you. So when you have a corporation, the accounting for revenues and expenses are the same as they are for partnerships. The difference between the accounting for partnerships and the accounting for corporations involves the equity section. Now, when you had your corporation, and most of your training so far in this curriculum has probably been on corporate accounting, you have your paid-in capital, your additional paid-in capital, which is also considered the common stock, preferred stock subject. And then you have your retained earnings, which is beginning retained earnings plus net income minus dividends gets you the ending retained earnings. So the paid-in capital through preferred stock, common stock, and your retained earnings totals up to be your equity section. Does that sound familiar with your previous studies and her and Sue's experience with her C Corp? Well, partnerships is different. You have a capital account for each partner, and that capital account will include the amount of money that you put into the partnership, which is conceptually equivalent to how much you bought in for with stock. And then your retained earnings part is your share of the partnership losses or gains will directly go into your capital account. And you'll have a drawing account. Remember way back in perhaps accounting 101 and 102, we were talking about a sole proprietorship, and they had drawing accounts, and that's how money came out of the sole proprietor business into the hands of the owner, so she could work it personally. The same concept on partnerships. They have drawing accounts, a draw account for each partner, and that draw account comes directly out of their capital account. So that's what we're going to be seeing today. Does anyone, I know I shared chapter 15 and 16 PowerPoints with you all. I plan on just going through the PowerPoint, but since you did have a day or two to review that and you've had the chapters available to you, do you have any specific questions that I need to know before we go through? I certainly will take questions as we go through, but do you have any specific questions now that I know I need to touch on as we go through? Sue said, not at the moment. And Jim says, not yet, but I reserve my right. And what about Gidget? No. Okay, so I will keep my eye out on the chat windows as I go through the PowerPoints. But if there's any spot that that there's questions, we will. I will certainly entertain them at that time. If it's hard to type in, I'll be glad to turn on all of your microphones. Because I want this to be a good session for you all. And, if there's a question that we need to explore, we can all explore the solution together. So I'm really good about that too. So let's start chapter 15, unless you have any questions. And I don't see any questions coming from. And next week, I will not have a veterinarian in the place right at the time I need to set up. So we will start exactly at 10 o'clock next week. Same bat channel, same bat time.
Okay. So we're going to talk about the formation, operation of partnerships and how the ownership can change inside of a partnership. We can relearn objectives. Let's just go into it. Basically, a partnership is an association of two or more people to carry on as co-owners of a business for profit. So it's not a non-profit venture, it's a for-profit endeavor. And the attributes are you have an agreement, express or implied. You're operating to make a profit, and the members must be co-owners. So the four of us right now could say, hey, we want to go into business. Why don't we be a partnership? And we could shake hands on it virtually. And at that moment, we have a partnership. It's that hard to set up, which is really, it can happen on a handshake. However, that's not a smart way of establishing a partnership, because how much money am I going to put in? How much money are you going to put in? What do you expect my time requirements to be? What are you going to be doing with the partnership? What are my skills? What are your skills? How are we going to operate this partnership? There's a lot of decisions to be made, and that's why we need to have an agreement. The implied agreement can lead you into problems, and the expressed agreement is on paper and very well thought out, and it's the rules that you will govern your partnership by, which is extremely important. And we are all co-owners, but we don't have to be equal co-owners. And we don't have to have the same level of responsibility, as we will see in a few minutes. So the advantages are it permits that we can pool our resources without the complexities surrounding a corporation. I'm a CPA and I'm a book author, and I also have a publishing company. So that those resources and those skill sets might be important to our partnership venture, where each of the three of you have your own strengths, your own weaknesses, and your own experiences that you can bring to the table for the benefit of our partnership. As I said, partnerships are easier and less costly to establish. Basically, just by being on this call and shaking our hands virtually, we could be in a partnership. We aren't, but we very well could be, just that easy. And then just get to the IRS and establish your FEIN number. Government regulations aren't strong for partnerships, and we are able to operate with flexibility, and the income is not subject to taxation at the partnership level. So it's taxed at the personal level. What other taxing entity is taxed at the individual level, but not the organization's level? Do you remember? Have you had taxation yet? Okay, I'm assuming silence would be, oh, they're thinking, okay. Okay, that's good. Basically, remember the corporations? We had a C Corp and we had an S Corp. And the C Corp gets taxed on its own. And then if you get dividends from that C Corp, you get taxed also. So that's where double taxation comes in, where an S corporation has a tax return that comes down to pre-tax, and then it has K1s inside of it for one form K1 for each of the owners of the business, each of the stockholders. and it has the stockholder's name and address on it, the stockholder's FEIN, or the Social Security number, and the stockholder's share of the profit. And that gets sent to the stockholder, and then that profit gets put into that stockholder's tax return, the 1040, and is not taxed. It's reported on the 1120S for S Corp, but the S Corp does not pay taxes. It distributes the taxation liability to the individuals, and the individuals have to put it on their tax return as taxable income. So it's very similar here. A partnership will have a partnership K1 coming out of its tax return, and the partnership doesn't pay tax, but the individual, their tax return, their 1040 tax return, is impacted by the profit or loss coming forth from that partnership for that year. Okay, so income is not subject to taxation at the partnership level. Okay, so the partnership that we just set up is a general partnership. We said we're going to go into partnership together. We shook hands virtually. We're done. It's a general partnership. And each of us is a general partner. That means we can bind the partnership, and therefore the rest of the members legally. So that's mutual agency. That's just a fancy way of saying I can, on the behalf of the partnership, I can sign a lease agreement. Sue, on behalf of the partnership, can go and sign a purchase, a loan document on behalf of the partnership to buy a building. Both of those are legally binding, and they also bind each of the partners, business as well as personal assets, because we are all responsible for those liabilities now. But each of us can actually sign and bind the partnership and therefore the partners legally. So that's what mutual agency means here. And you know, that doesn't feel too good, does it? I'd rather not have someone else bind me legally to pay for something if I wasn't part of the deal, right? So also a general partner, you have the right to dispose of partnership interests. Yeah, okay, Jim, good. There's unlimited liability, just like I mentioned. The liability for each of us can go well beyond what we put into the company. To contrast corporations, when you buy stock in Apple Incorporated, the amount that you pay for the stock that you purchase, that's as much as you can lose. You can't lose anything else. So if the stock becomes worthless, which it's not, but if the stock becomes worthless, your liability is limited to the amount that you pay for the stock. However, on a general partnership, we can each put in $10,000 in our own personal cash at the beginning, but we may have legally bound the partnership for all these liabilities for another $140,000. So we'll have to come up, if we dissolve the partnership, we'll each have to come up with how to we'll each have to figure out how we can put our personal cash into the partnership so the partnership can now pay off the rest of those liabilities. So it's our liability is not limited to our initial investment. It can be unlimited. And we can have a limited or uncertain life. If we all die in a month, which we're not going to, if we all die in a month, the partnership has ended. So it can be unlimited or uncertain. So perhaps we don't like the general partnership. So let's try a limited partnership. The limited partnership has to have at least one general partner and at least one limited partner. You can have more than one general and you can have more than one limited. Usually you have one general partner and then a whole bunch of limited partners. I kind of like that. Perhaps Gidget and Sue and Jim decided to be a limited partner, and they said, hey, you're the teacher, you're the general partner. And I'm going, oh, okay. Well, the general partner manages the company, and I would be liable for obligations. The limited partners, Gidget, Sue, and Jim, would invest money only. They'd have limited liability because their losses would be limited to their capital account, and they really don't have that much participation in management. I could be nice and listen to you all, but you don't have any responsibility to manage. This allows a general partner to raise capital without giving up management control. Then we have joint ventures. And those are by two or more parties to come up with a single or limited purpose for their mutual benefit. The life of that business is limited to that of the project. There's a written agreement governing the relationship, and each party participates in the overall management, and commonly organized as corporations or partnerships. I've been involved in, when I was with Southwestern Bell, they had a couple joint ventures. Joint ventures are used quite a lot in businesses when each corporation has its own mutual thing that they can contribute to the project, but they need the other side, and the other company has that resource to contribute. A long time, this story will date this experience, but Southwestern Bell had a joint venture with a Yellow Pages company, a Golden Pages company in Israel. And Israel were the new thing at that time, and this is going to sound funny, the new thing at that time was email, because we hadn't had email yet, but they had an email system that they were launching through this thing called the internet. So they had the technology and they had the product of an email system, but we had the knowledge and product of a Yellow Page telephone directory advertising system, which had to be called Golden Pages in Israel because of World War II issues, because nothing sells in Israel if it's yellow. It has to be golden. The page colors, though, the tone of the pages were the same shade of golden yellow as they are in the United States, but they're called the Golden Pages in Israel. So we had the Yellow Page process, and they had the email process. So the joint venture was to get email to the United States and Yellow Pages to Israel. So that was the actual purpose of that joint venture. When the purpose was over, then that joint venture was over. So it's not a lifelong, I lost sound? I'm back. Okay. So where did I drop off? Did you hear me about Southwestern Bell and the joint venture? Okay, the Golden Page and the internet, and that was the two things that we needed to share. And that was the purpose of the joint venture. Okay, thank you, Jim. Okay, in that partnership agreement, we should consider what we're going to call ourselves and the identity of the partners. Like we stated that I'm the general partner and you're the limited partners. And we need to state the nature and purpose and scope of the business, the effective date that we're going to begin our business, and how long will the partnership operate. Is it going to be for our lives? Is it going to be forever? Is it going to be for the next 5 years? Where are we going to have the place of business? Kind of gets interesting if it's going to be a virtual partnership or a business location partnership. What is the provision of allocation of profit and losses? So even as limited partners, you have a share of profit and loss, and you have a contribution of your capital, and you can also have draws coming out of your capital account. So how are we going to allocate that? We can allocate that for each of us differently. And what about provisions for salaries and withdrawals from partners? Just because you're a limited partner doesn't mean that you cannot also be paid a salary for your expertise. So that's like a double-edged sword. You can be paid a salary, plus you can have ownership inside of the partnership, an ownership proportion of that partnership. You have rights and duties and obligations identified for each partner. That would be where we would say the general partner is the only one that can bind legally the partnership for any of the legal agreements that they would get into, where the limited partners would not be. But if we were all general partners, then we would possibly want to have one be the only one to sign agreements, just so it would be controlled. And then we have the authority for each partner will be in contract situations, which I just mentioned. What happens if your best friend, you just met a person and it happens to be Jim's best friend? He would be a fantastic partner. What's the procedure of bringing in a new partner? What happens if a partner needed to withdraw because of personal reasons, or doesn't want to be part of the partnership anymore, or even worse yet, that particular person passed away? What's the procedures of the partnership to continue after that? What happens if you get divorced and then your partnership agreement, your partnership is a marital asset, and now you're in court, everything is going to be divided in half. So now the ex-spouse has half of your ownership in our partnership agreement. Are we going to allow that, or do we want to have a partner who happens to be the ex-spouse of one of our current partners? That can get pretty messy. So we need to establish how to buy each other out if we need to. So the lesson here is, at the beginning of the partnership development stage, when you're doing this agreement, you also have to think of and plan out how things would happen, specifically when you actually dissolve, or we're getting in a fight and we have professional differences, or one dies, or one gets divorced. How are we going to handle the removal of one of us, or all of us, or a few of us from this partnership? It's best to do it while you're still friends and excited about going into the partnership. It gets messy to try and do all this stuff at the end when you're trying to leave a partnership. Okay. What accounting practices are to be followed and whether or not you're going to demand an audit. So you have two types of interest. You have capital interest, which is the amount that you put in as your initial investment. Your claim against the net, what's the word? Assets of the business, or your interest in the income or loss. So let's continue on. You could be on a cash basis or tax basis accounting, and you certainly, most of them adhere to GAAP. Partnership equity section I mentioned before is capital and the drawing account. So let's look here. We have Tom and Julie, and they form a management consulting partnership January 1. The fair value of the net assets invested by each partner. So Tom put in $13,000 of cash. He brings into the partnership $8,000 of accounts receivable that when it gets collected becomes the partnership's cash. He contributes $2,000 in office supplies, $30,000 in office equipment, but the office equipment he's carrying an accounts payable of $2,000. And then Julie has similar numbers for herself, and she also brings in a mortgage payable for the business. She's got the land and the mortgage payable on the building. So during the year, Tom took out $15,000 and Julie took out $12,000. And the net profit for the business was $50,000, which is allocated based on the original net capital investment. Okay, so let's see what the next step is. So Tom, his journal entry will be, let's go back, 13, 8, 2, 30, and 2, right? So 13, 8, 2, 30, and 2. So 13 for cash, accounts receivable 8, supplies 2, office equipment 30. Those are the assets, and this is the journal entry of the partnership. So these are the assets that Tom brought in. This is the liability that Tom brought in that the partnership will incur. And the balance of these netted out is $51,000. So Tom's capital account, his initial investment is $51,000. However, let's go back to see Julie's amounts, which is 12, 6, 8, 35, and 18, 8. 12, 6, 8, 30, 15, and 18, 8. So the same type of journal entry will happen for Julie. So these are the assets that she brings in. These are the liabilities that the partnership will incur because of the assets that she brought in. And her capital account will begin with a $25,000 amount. Remember, Tom is more than twice her capital account with 51. So 51 and 25. Now we're going to record withdrawals. So cash is going to be brought down, and Tom is going to have $15,000 taken out for his drawing account, as well as Julie. So credit to cash and then debit to the drawing account. And now we're going to close the income summary. So the income summary, does everyone remember how the income summary would get the $50,000? I know we were told that the net income for the year was $50,000, but in the general ledger, we have balances in our revenue accounts and in our expense accounts. So do you remember how those revenue and expense accounts get into the income summary? Good. So I will review that quickly. Okay. So what happens? You have the general ledger going, and we have revenue and expense accounts as well as balances in our assets, liability, and owner's equity accounts or capital accounts. So the assets, liability, and capital accounts are considered permanent accounts. Those balances are never closed out to be zero. However, the revenue and expense accounts, which revenue minus expenses is net income, the revenue accounts and the expense accounts at the end of the year, each of the balances in those accounts get to be zero, and then you're going to put the balance into an account called income summary. For example, the first journal entry will be listing off each of the revenue accounts, and then you're going to debit the revenue accounts by the amount of their balance, and that debit would make that account zero because revenue accounts have a credit balance. So you're going to zero out the accounts, each and every one of them, and put the offset into an account called income summary. And then in a corporation, that income summary goes into retained earnings. So income summary would have a credit balance because you had net income. Now we're going to, in a corporation, you would debit income summary, zeroing it out, and then you credit retained earnings. But this, in a partnership, you're going to credit each of the partners' individual capital accounts. So income summary will be zeroed out to be 50,000 by 50,000 debit. And then Tom will get 33,553, and Julie will get 16,447. Does anyone remember why Tom is getting this amount and Julie might be getting this amount? Or how that would be calculated? Okay. So remember back, Tom put in, I believe, 51,000. And Julie, okay, Tom's initial capital was 51,000, and Julie's initial capital was 25,000. And it said that net profit was 50,000, which is to be allocated based on the original net capital investment. So with Tom having 51,000 and I forgot her name, Julie has 25,000. So that would be $76,000 total, correct? So Tom would have $50,000 times 51/76, and that would be $33,553. Likewise, Julie is 25,000 divided by 76,000 times the $50,000, and that would be 16,447. Does that make sense? Do you see where that came from? Okay. So then we have the two drawing accounts that we have to get out of the, remember we had these journal entries that reduce cash but establish the draw account. The drawing account is also a temporary account that needs to be closed out into the capital accounts, just like their cousin, the dividend account in the corporations, had to be closed out into retained earnings. Same parallel concept. So these drawing accounts need to be zeroed out and put directly into the capital account. So that's what we see here. The drawing account that had a debit of $15,000, now we credit it to zero it out, and then we're going to reduce Tom's capital account by $15,000. Same thing with Julie. So these are the closing out of the drawing accounts and closing out of the income summary. So now we're going to talk about allocation of net income and net loss. And the partnership agreement should indicate how income and losses are allocated. Sometimes it could be fixed based on a fixed ratio. It could be regardless of how much money the two put in, it could be established to be just shared 50-50. 50% for one, 50% on the other, 10%, 90%, whatever, but the percentages need to be equal. They need to be, they can be, don't have to be equal, but they have to add up to 100%, obviously. It could be a ratio based on capital balances. In this situation, it would be, for Tom, it would be 51 divided by 76. And for the lady, it would be 25 divided by 76. Because that's based on the initial capital investment. I don't know what the capital balance is, but whatever it is, it would be the Tom's balance divided by the total of the two balances. And then the ladies would be the ladies' balance divided by the total of the two balances. It could be based on a fixed salary allocation. Let's say one makes $10,000 of salary a year and the other makes $100,000 salary a year. It could be based on that allocation, or it could be a bonus as a percent of net income. So there could be a variety of schemes of allocations here, and they would be all to be correct and proper. So let's see what this next one is all about. Let's see. Check my text box. And I'm still coming through okay? My sound's okay? Okay, good. So I haven't put you to sleep yet. I've been breaking up. I'll have to just go somewhere else next time or have it on my personal hotspot. It has to be my Wi-Fi. It'll get better next week. I'm so sorry. Okay, so here we have exercise 15.5. On January 1, Tony and John formed T&J Personal Financial Planning, and they invested $480,000 and $340,000 respectively. And they agreed that profits are to be allocated as follows. First, annual salaries at 42 and 66 are granted to Tony and John. Then John is entitled to a 10% bonus of net income after salaries and bonus, but before interest on capital is subtracted. So after salaries, John gets a bonus, and then they have interest on capital investments. So each partner is to receive an 8% interest on the original capital investments, and the remaining profits are allocated 40% to Tony and 60% to John. This is very common. So this is not one of those contrived academic accounting exercises. So on December 31st, though, the partnership reported net income before salaries, interest, and bonus of $188,000. So let's see what happens. Calculate the allocation of the partnership's bonus. The bonus is 10% times income after salaries, but before the bonus. So all this algebra comes down to be 7,273. And basically you can prove it with 188,000 net income minus the salaries of 108,000. Remember, 42 and 66 is 108. and the bonus is 7,273, which leaves net income subject to the bonus of 72,727. 72,727, a tenth of it is 7,273, which is exactly what this calculation provided. So the bonus that was calculated and then was proved. So let's allocate the partnership profit of 188,000. First, and this was how it was defined by the partnership agreement. Other partnership agreements can be in different orders, but this partnership agreement is how we have to go by. So the first one was salary, 42,000, 66,000, and that totals 108,000. The bonus on the previous slide, Tony is 0, but John gets 7,273. And then capital on the interest is 38,400 and 27,200. So that was able to us to get totals. And then we had a remainder. We had 100. The first three lines add together totaled 180,873, but we had a profit of 188,000. So remember, anything in excess of anything left over would be split 40% and 60% to Tony and John. So Tony gets 2,851, John gets 4,276, and so now our totals of 83,251 and 104,749 equals our profit of 188,000, and these are the amounts that will go into the capital accounts. The sound got lost again? Okay.
1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Yes or no? Hello, hello. I'm still breaking up. Okay, let me try one more thing. Okay, A, B, C, D, E, F, G, H, I, J, K. Yes or no? Okay. That will be remedied by next. This is the first time this has happened this way, so I'll have it remedied a little bit better. Yes, better. Okay. I'll have it figured out better for next time. So, okay. Really? Oh, good. That because it could be a Zoom issue then, instead of a local system issue. Thank you for that, Gidget. Okay, so we have. Did you get any of this? Do I need to do a quick review of what we did here with Tony? Yes, do a review. Okay. Okay, this is a situation where, and this is very common, but how the exercise is written, this is the actual how the partnership agreement is. So don't think that every partnership agreement is going to allocate salaries first. You have to go with how the legal words are stated in the partnership agreement. So in this case, we have salaries of 42 and 66%. 42 and 66,000. Here we have John is getting a bonus of 10% of net income after salaries, but before interest on capital investments. Each partner is going to receive an 8% interest on their original capital investment. And remember, the original capital investment is 340 and whatever this other number is. 480,000 and 340,000 is the initial investment that the 8% is going to be calculated on. And if there's any profits remaining after that, it's going to be allocated 40% to Tony and 60% to John. And they had net income reported before salaries, interest, and bonus of 188,000. So we're going to have to allocate that 188,000. The calculation of the bonus will be this algebra, which will get you the result of 188,000 is net income minus salaries, minus the bonus will get you 72,727. Well, 10% of 72,727 is 7,273. So this algebra and how it was lined out worked perfectly because we needed to have 10% of the net income after salaries become a bonus to the partner, one partner. So now we have salary of 42,060 and 66,000. From the previous slide, Tony gets nothing, but John gets 7,273 as that bonus. And then each of them will get their 8%, was it? 8% interest on their initial capital investment. And that brings us down to allocating $180,873 of the net income. Now, that's under the amount of net income, so we have to do something with the 7,127, and that's where we were told 40% to Tony and John gets 60%. So Tony gets 2,008 and John gets 4,002, and that's how the 7,127 gets allocated. When everything is added and cross-totaled, we have now allocated $188,000 between Tony and John, based solely on the wording inside of the partnership agreement. What happens if we don't have this is a good problem because the salary and the bonus and the interest were the incomes that they expected, and it only came up to 180,000, but they had 188,000 to divide up between themselves. So they had, yes, we made it through. Okay. Yes, we made it through yay, we made it through the problem. That's where you were going. Yes, we did. So this is a good problem because they had extra money to divide up. But what if you made less than the 188,000? And that's the next problem. So this is insufficient income to cover allocation. So I need to move this up a little bit. Okay, so here we have an amount where the salary and interest exceeds the net income, So we have an insufficient situation. So how are we going to handle an $11,000 deficit? Well, in this situation, we have Adams and Brown, which is a different group. So they had salaries of $4,002 and interest of $62,003. I don't think that's 62,000. That's a typo. It's 6,200, and 3,000 gets you a total of 9,200. So Adam's total is, this is a really weird thing. This 62 is 6,200 because 6,200 and 3,000 gets you 9,200. And this has to be 10,200, which is 4,000 plus 6,200 will get you 10,200. So this is a typo. This should be 10,200 plus 5,000 gets you 15,200. But how do you allocate a deficit? Well, in this case, since it wasn't stated, you allocate the deficit 50-50. So the excess allocation has to be 2,100 for one, 2,100 for the other, and that would get this 15,002 down to 11,000. And that's how that one would work. So we got through a second one. Okay, problems in allocating income and loss. It's the same change. Laugh out loud. And it's the same, if you can't laugh about something, it's not worth crying, right? Just have a good attitude. Thank you, Gidget. So the same change in capital accounts as if the salaries and interest were considered an allocation of profit and amounts are treated as an expense should be disclosed. What happens if you have problems in prior years, like an error from last year or 2 years ago? What happens if a partner's altered profit and loss agreement since the period in which the error occurred? And they had to all be corrections or allocated to the partnership accounts directly. Okay, financial statement presentation, differences from GAAP. Changes in equity should be disclosed. Salary allowances are generally not an expense. And there's no income tax expense for the partnership because, remember, the partners have to have the burden of the taxation for the partnership on their personal tax return. And any interest allowance on capital investment is considered an allocation of profit. Just like, these are just fancy words for doing this. Interest is part of the allocation of net income. It's not an expense inside of the partnership. It's interest that the partners get, and it's just a way of allocating income before salary to the partners, bonus to the partners, and interest to the partners. So it's all done as a partnership allocation. And to prepare a statement of changes in partners' capital for the year ended December 31st, you have this is a new partnership, so Tom and Julie have no balances to begin with. Remember that we made the initial investments of $51,000 and $25,000. Then we added net income of $33,000 and $16,000 to get $50,000. And this was allocated based on Tom got $51.76 of $50,000, which is $33,000, and Julie got $25.76 of $50,000, which is $16,000, and so the two added together is $50,000. So their totals are in the fourth line, and then they had withdrawals of $15,000 and $12,000. So their capital balances are $69,000, $29,000, which adds up to $99,000. So it's 11:02. Let's see what else we really need to touch on that you can't. Admission of a new partner, that works pretty well. Anything that I really need to explain? This is laid out pretty well. Okay. Okay. What I'm going to do is let you go for the day. It's after 11 now. I do have a session where I don't think a lot of people will be attending. If you have questions on this on Friday, I think my session is at 11 a.m. on Friday, and I will post that link also as a second link or as an announcement. I'll post it as an announcement. And on Friday, I basically host a live session waiting for people to call in for Accounting 101. If they don't call in, I'm going to be on that session by myself. If there's issues about the remaining part of this slideshow, you can certainly contact me at that time. You can call me or set up a private Zoom at a different time. If there's problems in understanding the materials, I think we got you off on a good start for partnerships, but it's hard to get really deep into these subjects because you're on some major subject areas that can go really deep, but you have 1 week to cover them. So how quickly and how deep do we cover these subject matters is the question. So I would be glad to answer questions live on that session on Friday, since I probably won't have very many people on that session. Friday morning at 11 a.m. Mountain Time. Or you can always email me or contact me, and I'll be glad to walk you through a particular part. If you want me to review your homework before you actually submit it for actual assessment, I'll be glad to quickly look at things to see if you're on target or if you need to adjust a particular area. So how does that sound? Okay, great. So it's been a pleasure meeting each one of you, and I hope you're optimistic about this course. We have 3 more weeks after this week. They go by so fast. And next week begins the nonprofit and governmental accounting sessions, which is a different way of looking at accounting. So this is a little bit different. Partnerships is a little bit different way of looking at the equity section of a business. But the next 3 weeks, some of our training will be adjusted from accrual accounting. So it should be an interesting ride. So thank you. Have a great remaining part of the day, and I'm here to support you no matter what, but let's not put everyone to sleep. And I'll try and get better. I'll try to figure out what happened with the sound, but I was thankful that Gidget said that this was a problem last night on her session. So have a good day, and I'll talk to you all later. Bye-bye. Oh, thank you, Jim. Bye-bye.